Thank you for standing by. My name is Eric, and I will be your conference operator today. At this time, I would like to welcome everyone to the APEI 3Q25 earnings call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star 1 again. Thank you. I'd now like to turn the call over to Brian Prenoveau, Investor Relations. Please go ahead.
Thank you, and good afternoon, everyone. Welcome to American Public Education's conference call to discuss third quarter 2025 results. Joining me on the call today are Angela Selden, President and Chief Executive Officer, Edward Codispoti, Executive Vice President and Chief Financial Officer, Barry Jansen, Senior Vice President of Growth and Strategy. Rick Sunderland, Executive Advisor to APEI, is also on today's call and will be available for the Q&A session. Materials for the call today are available in the Events and Presentations section of APEI's website. Statements made during this conference call and any accompanying presentation regarding APEI and its subsidiaries that are not historical facts may be forward-looking statements based on current expectations, assumptions, estimates, and projections. Forward-looking statements are subject to risks and uncertainties that could cause actual results to differ materially from those expressed or implied by such statements, such as those identified in our Form 10-K under the heading Risk Factors, including those related to potential impacts from government shutdowns or changing federal or state government policies, practices, and laws, including impacts on revenues or the timing of receivables. Forward-looking statements may sometimes be identified by words like anticipate, believe, seek, could, estimate, expect, can, may, plan, potentially, project, should, will, would, and similar or opposite words. Forward-looking statements include, without limitation, statements regarding expectations for registration and enrollments, revenue, earnings and adjusted EBITDA, and other earnings guidance, our foundation for growth, the planned combination of our institutions, governmental and regulatory actions, their impact, and our response to those actions, changing market demands, and our ability to satisfy such demands and other company initiatives. This presentation contains references to non-GAAP financial information. A reconciliation between the non-GAAP financial measure we use and the most directly comparable GAAP measure is located in the appendix to today's presentation and in the earnings release. Management believes that the presentation of non-GAAP financial information provides useful supplemental information to investors regarding its results of operations and should only be considered in addition to and not as a substitute for or superior to any measure of financial performance prepared in accordance with GAAP. With that said, I'd like to turn the call over to APEI's President and CEO, Angela Selden. Angie, please go ahead.
Thank you, Brian. Good afternoon, and thank you for joining American Public Education's third quarter 2025 earnings call. Before we begin with the third quarter results, I would like to take this moment to introduce Ed Codispoti, APEI's new Chief Financial Officer. Ed joined APEI on October 20th, 2025, and we're very excited to have him on board. Ed joins us from NV5, a leader in technology and engineering consulting solutions. Prior to NV5, Ed was CFO of Alumno Holdings, a higher education company providing learning platforms and technology solutions to universities in Latin America. I will let Ed introduce himself further before he provides the financial overview. I also want to take this opportunity to thank Rick Sunderland for his dedicated service. For over 12 years, he has been instrumental in building and shaping APEI. During Rick's tenure, APEI has navigated significant transformation across the enterprise, including the integration of new institutions and strengthening of the company's long-term position. Rick has been a steady hand, always steering APEI in the right direction through periods of growth and change, and his leadership has left a lasting positive impact on the organization. We appreciate that he has agreed to serve as an executive advisor over the next few months to facilitate a smooth transition. We will certainly miss him while also wishing him the best during his next chapter. Moving on to the third quarter, we have 4 areas to highlight during today's call. First, I am very pleased with APEI's third quarter 2025 performance, as we have again exceeded our guidance ranges for all metrics, including revenue, net income, EPS, and adjusted EBITDA, through continued registration and enrollment momentum and expanding margins. Registration and enrollment growth has outpaced our forecasts and significantly contributed to the outperformance in our financial metrics. Registrations at APUS in the third quarter increased 8% as compared to 3Q24. This also represents a sequential acceleration in the rate of growth from 2Q25. Enrollments at Rasmussen increased 10% versus 3Q24. This represents the 5th consecutive quarter of year-over-year enrollment growth. I am particularly pleased that on-ground enrollments at Rasmussen are accelerating, taking advantage of our existing capacity, or what we call filling the back row. Enrollments at Hondros College of Nursing continued their strong momentum, increasing 18% as compared to 3Q24. Second, as previously disclosed, we completed the sale of Graduate School USA on July 25th, 2025. Early this year, as we prioritized the combination of our degree-granting institutions, we determined that the graduate school training business was no longer a strategic fit within our future growth strategy. We were very pleased to find a new home for graduate school that is more aligned with its mission and market position, allowing us to focus on growing our core degree-granting businesses, including the military-affiliated, veteran, nursing, and other healthcare communities. Third, as we continue our work to simplify the overall operational businesses at APEI, at the end of Q2 25, we received HLC approval and submitted our combination request to the Department of Education. In Q3 25, after dialogue with the Department of Education team newly assigned to our transaction, we were informed that we should follow a different process for the planned combination of our institutions rather than the one originally undertaken. As a result, in September, we were required to submit and completed the submission of a new application first to the HLC, which will be reviewed at their board meeting in February of 2026. This application contains substantially the same content as our prior submission. We have also provided to the Department of Education our expected timeline for the completion of this newly submitted combination plan to take effect in the beginning of the third quarter of 2026 for the 2026 Student Financial Aid Award year. Fourth, our simplification actions have also strengthened our balance sheet and should enable our subsidiary institutions to continue to produce improved financial results. With the Department of Education removing the restrictions on the $24.5 million letter of credit that dated before the close of our acquisition of Rasmussen, that cash, now unrestricted on our balance sheet, contributes to the unrestricted cash and equivalents totaling $193.1 million as of September 30th, 2025. As a result of our recent redemption of our preferred equity at the end of the second quarter, we will save approximately $6 million annually from the elimination of the cash dividend payments. Also, the sale of graduate school eliminated a $28 million lease liability, which will save us approximately $4 million in lease payments annually and also reduces our total liabilities. These changes have improved our cash position and will increase our cash flow by approximately $10 million per year on a pre-tax basis, which will meaningfully improve net income and earnings per share. We believe we are now positioned with more financial flexibility and an improved capital structure to more confidently pursue our growth initiatives. Moving now to more details about the third quarter 2025 results, starting first with APEI's nursing and healthcare institutions. Rasmussen continues to produce strong results. Rasmussen's enrollment increased 10% in 3Q25 and 9% in 4Q25, representing the fifth and sixth consecutive quarters of year-over-year enrollment increases. As mentioned in previous calls, by leveraging its existing fixed cost structure, Rasmussen has been and will continue to experience increased operating leverage as enrollments continue to increase. Continued enrollment growth will also flow through to EBITDA margins. Importantly, we are carrying an additional 1,300 enrollments into 4Q25 as compared to 4Q24 that we will continue to build upon in 2026. With our current campus footprint, we believe our strategy that we call filling the back row by working to ensure each of our classes and sections is maxing out capacity at our current campuses has been successful with increasing enrollments and improving EBITDA flow-through on each incremental student. At Hondros College of Nursing, as previously reported, 3Q25 enrollment was strong with 18% growth as compared to 3Q24. 4Q25 enrollments continue a positive trend, increasing 9% year over year to 4,000 students off of a very strong prior year comp. We believe that the business combination of Rasmussen and Hondros College of Nursing will provide us with an improved platform to add programs, scale enrollment, and increase margins. Turning to APEI's online university educating our nation's military, veterans, and their families, in the third quarter, overall APUS net course registrations increased 8% year over year. Revenue at APUS also increased over 8%. Turning our attention to Q4, the government shutdown has muted military enrollments at APUS for October and November. We are, however, pleased that several of the military branches are now authorizing tuition assistance benefits through the use of the $100 million of tuition assistance funds that were authorized in the One Big Beautiful Bill Act. Further, those branches have been selectively bringing back furloughed workers to help assist with those TA approvals. Additionally, last night's Senate test vote yielded enough votes for the amended CR to pass the Senate, perhaps even today, and head back to the House for consideration, possible approval, and passage to the President for signature, perhaps as early as the end of this week. It is our understanding that upon presidential signature, workers would be called back from furlough and TA funds would again be available for use during the CR period. We remain confident that TA will continue to be a critical Department of Defense recruiting tool, as it is a benefit to service members in exchange for voluntary enlistment. It is also seen as a force-shaping tool, because by offering these educational opportunities, the military can attract and develop human capital with a higher skill set, thus strengthening our U.S. Armed Services Forces. As we await the passage of this CR and the Defense Appropriations Bill, we have implemented various cost-saving measures and are continuing to evaluate additional opportunities to mitigate the adverse impacts. Overall, across our three education units, we are so pleased with the resilience of our team, especially given the government shutdown uncertainty. We've delivered consistent performance that we've demonstrated over the last 18 months. We are confident in our ability to continue executing and taking advantage of the growth drivers that we believe will accelerate growth and profitability and provide more students with more educational opportunities. We look forward to welcoming investors and analysts to our November 20th, 2025 Investor Day at the New York Athletic Club in New York City to provide a longer-term view of APEI's growth strategies and financial outlook. APEI enables students to experience a valuable lifelong return on their educational investment. Our vision remains to offer education that transforms lives, advances careers, and improves communities by providing online and campus-based post-secondary education to over 107,000 students. Our mission, to power purpose, potential, and prosperity for those in service to others, reflects our focus on a student population which is resilient in the face of AI transformation and potential threats. Our nursing education prioritizes in-person bedside care, and our military service members continue to be critical, active participants to U.S. military strategies. Each of our education units is purpose-built to deliver accessible and affordable higher education across a diverse range of subjects. I'd like to thank each of our employees and faculty that work tirelessly to make our mission a reality. With that, I will now turn the call over to APEI's new Chief Financial Officer, Ed Codispoti.
Thank you, Angie. I'm delighted to be on today's earnings call as I begin my 4th week with the company. As Angie mentioned earlier, I came to APEI after serving as CFO of NV5 Global, an engineering and technology solutions firm. And before that, I was with Alumno Holdings, a company that owned universities and delivered technology solutions to higher education institutions across Latin America. The CFO role at APEI is an exciting opportunity to bring together my experience in driving growth and advancing higher education while focusing on meaningful student outcomes. I'd also like to say that I very much appreciate working with Rick Sunderland, who has done such a great job as CFO of APEI for over 12 years. The transition so far has been seamless. I look forward to meeting with investors and analysts in the coming weeks and months. Turning now to our quarterly results, total revenue in the third quarter was $163.2 million, an increase of $10.1 million, or 7%, from the prior year period. As you know, we sold Graduate School USA in July. If you exclude Graduate School USA, third quarter revenue of $800,000 and third quarter of prior year revenue of $8.1 million, our revenues would have been 5% higher, or aggregate growth of 12%. Total costs and expenses in the third quarter were $153.5 million, an increase of $4.5 million, or 3% as compared to the third quarter of 2024. The increase was primarily driven by a $3.9 million loss related to the sale of Graduate School USA in July 2025, and a $2.5 million increase in advertising costs as we invest in student enrollment for growth. In the third quarter, net income available to common shareholders was $5.6 million, which was almost 7 times higher than net income of $700,000 in the prior year. And EPS increased significantly to 30 cents per diluted share in the third quarter of 2025 versus 4 cents in the third quarter of last year. Third quarter adjusted EBITDA increased 60% to $20.7 million as compared to the prior year period adjusted EBITDA of $12.9 million, driven by increased revenue and margin expansion of 424 basis points. This was above the top end of the guidance range and represented an adjusted EBITDA margin of 13% as compared to 8% in the prior year. Looking now at our segments, at APUS, third quarter revenue increased $83.1 million, an 8% increase as compared to the prior year period. The increase was driven by third quarter 2025 net course registrations, which increased 8% as compared to the prior year period. EBITDA for APUS was $26.2 million for the quarter, a 19% increase over the prior year period. At Rasmussen, third quarter revenue was $60.8 million, an increase of 16% as compared to the third quarter of last year. The increase was fueled by a 12% increase in on-ground enrollment and an 11% increase in online enrollment. This enrollment growth brings total Rasmussen student enrollment to 14,900 students and contributed to our EBITDA of $825,000, which grew significantly from the EBITDA loss of $4.5 million in the prior year period. At Hondros College of Nursing, third quarter revenue was up 19% to $18.4 million as compared to the prior year period due to continued enrollment growth. For the quarter, Hondros College of Nursing total enrollment increased 18% to approximately 3,700 students, and third quarter EBITDA was a loss of $336,000 compared to the loss of $259,000 in the prior year period. Our balance sheet and cash flows also improved when compared to the prior year period. Cash flow from operations for the 9 months ended September 30, 2025 increased 56% to $73.5 million. Our free cash flow, defined here as adjusted EBITDA less CapEx, nearly doubled for the 9-month period at $45.2 million. As of September 30th, 2025, total cash equivalents, and restricted cash increased 22% to $193.1 million, an increase of $34.2 million from the year ended 2024. Subtracting our $96.4 million secured note, our net cash position was $96.7 million at quarter end. Additionally, as noted earlier, at the end of the second quarter, we redeemed all our outstanding preferred stock for $43.1 million and completed the sale of 2 corporate administrative office buildings in Charlestown, West Virginia, for net proceeds of $22.5 million. CapEx totaled $11.8 million in the first 9 months of 2025 compared to $17.7 million in the prior year period. Principal on APEI's term loan at September 30 was consistent with the prior quarter at $96.4 million, and our $20 million revolving credit facility remains fully available. I believe this demonstrates the strength of our balance sheet, which we believe positions us well for future growth. Turning now to our fourth quarter and full year outlook, which covers forward-looking statements subject to the various risks noted earlier. Before I discuss our guidance for fourth quarter 2025, it would be helpful to refer to slide 12 of the presentation deck so that we can describe how we have incorporated the government shutdown in our guidance. Our original revenue guidance for full year 2025 was within a range of $650 million to $660 million. We are pleased that APUS and Rasmussen outperformed with respect to our previous expectations by about $22 million. Additionally, we sold Graduate School USA in 2025, and its negative impact to the guidance, including its first half underperformance, was approximately $18 million. If we assume that the shutdown would result in an impact to revenue between $20 million and $24 million, our revised guidance for the year would be $640 million to $644 million. For the fourth quarter 2025, APUS total net course registrations are expected to be between 65,000 to 74,400 registrations, representing a 33% to 23% decrease when compared to last year, impacted by the government shutdown. At Rasmussen and Hondros College of Nursing, fourth quarter student enrollments are actual because the quarterly starts at these schools are known at this time. At Rasmussen, fourth quarter total on-ground enrollment increased 13% to approximately 7,100 students, and total online enrollment increased 6% to approximately 8,800 students, for an aggregate enrollment of approximately 15,900 students. This represents a 9% increase when compared to the fourth quarter of 2024. At Hondros College of Nursing, fourth quarter total student enrollment increased 9% year over year to approximately 4,000 students. In the fourth quarter of 2025, consolidated revenue is expected to be between $150 million and $153.5 million, again impacted by the government shutdown. The company expects fourth quarter net income available to common stockholders to be between a profit of $5.9 million and $8.3 million, or between 32 cents and 45 cents per diluted share. Fourth quarter 2025 adjusted EBITDA is expected to be between $18.5 million and $22 million. Therefore, for the full year 2025, we are changing our anticipated consolidated revenue to a range of $640 million to $644 million. Net income available to common shareholders for the year is expected to be between $17.2 million and $19.6 million. Our full year 2025 adjusted EBITDA guidance is between $75 million and $79 million, and our full year CapEx is expected to be between $15 million and $17 million. The updated full year adjusted EBITDA and CapEx guidance translates to free cash flow expectations for the full year, defined as adjusted EBITDA less CapEx, to be between $58 million and $64 million. I'll now pass it back to Angie for closing remarks, after which we will begin our question and answer session. Angie?
Thank you, Ed. Great job on your first call. In closing, we have spent much of the past year setting financial and operating goals and then delivering on those results. Rasmussen and Hondros College of Nursing are delivering consistent, positive enrollment growth and profitability. APUS, with the exception of the market anomaly of the government shutdown, continues to deliver growth and high margins. At the beginning of the year, we set expectations for redeeming our preferred equity, selling our corporate buildings, and simplifying our business structure, and we have delivered on these actions. Our organization was purpose-built to deliver affordable and accessible educational opportunities in fields which are in high demand. We believe that our platform and the sector tailwinds set APEI up to accelerate growth and bring more educational opportunities to a greater audience across the country and across the world. We are as optimistic today as we've ever been about the long-term potential of our company, and we look forward to sharing more details about that long-term potential on our November 20th Investor Day in New York City. With that, I would now like to hand the call back to the operator to begin our question and answer session.
At this time, I would like to remind everyone, in order to ask a question, please press star followed by the number 1 on your telephone keypad. Your first question comes from the line of Thomas White with D.A. Davidson. Please go ahead.
Great. Thanks for taking my question. Good evening. First off, nice results in the quarter, guys. Congrats to you, Ed, on the new role, and good luck to Rick going forward. I guess just on the tuition assistance disruption at APUS, I was hoping, Angie, maybe you could just talk a little bit about your plans for driving kind of re-enrollments for the students that were forced to be dropped. And I don't know, do you guys expect that there will be any sort of permanent demand, kind of destruction as a result of this, or is it just temporary? And then I had a follow-up.
Okay, great. Thanks, Tom. First, I would say a couple things are happening, right? And I like to just emphasize a few. Even though the CR has not yet been approved, we are so pleased that the 3 largest branches, Army, Air Force, and Navy, are using the One Big Beautiful Bill, $100 million of tuition assistance funds, to allow service members to register even without the approval of the CR. So we have seen more registrations flowing in December than we had in October and November as a result. So we're very pleased that we're starting to see demand come back already in December, even without the passage of the CR, and inside the CR is the Defense Appropriations Bill. We have electronic marketing campaigns to every single student who was registered in October and November and who got dropped for non-payment. And we fully expect that those folks are going to continue their education. This has only happened once in the last 12 years, which was the last time was in 2013. And the result of that was no decrease in our demand. So while we can't be certain about what our future expectations for TA enrollments are going to be, that data point tells us that this should be a short-term matter and not a long-term decline in our expectations for TA enrollment.
Oh, great. That's very helpful. Thanks. And then just maybe one follow-up, if I could, on the kind of on the plan to integrate the 3 institutions. It sounds like maybe there's been a minor speed bump there. Can you just maybe explain whether the new process, does it change at all kind of how you're thinking about the ultimate, benefits of integrating the 3 institutions, either from sort of an expense or revenue synergy standpoint? Thanks.
Sure. Great question. We remain very committed to the combination of our 3 institutions, and nothing has changed about our conviction around that. I would say that this is a procedural matter. There's a different form that we needed to complete. And when we submitted to the HLC the second time around, instead of 3,600 pages of documentation, we submitted 4,000 pages of documentation to support the change. But I would say substantially all of what we had in the first submission was reused and reorganized for the second submission. When the Department of Education was reduced in force at the beginning of 2025, we received a new team assignment, and that team assignment had a different view on which process we should follow than the team we had been working with prior. And so with that, we needed to recalibrate. We are completely in compliance with that new process and are still on track with dialogue that we've had with the Department of Education for the expectation of a 3Q, third quarter 2026 implementation in time for the 2026 financial aid award year. So we will continue to brief people if something were to change there, but that's fully still the timeline we're operating against.
And this is Gary. On your second question about synergy opportunities, we're moving ahead with the opportunity to cross-pollinate the revenue. You'll hear more about that on the Investor Day. So we're not sitting back and waiting for the combination to occur to move forward with our plans to, expand our campus footprints as well as, cross-pollinate programs from Rasmussen to Hondros in the interim period. So we don't see the timing as being an obstacle for that.
Thank you very much.
Thank you, Tom.
The next question comes from the line of Stephen Sheldon with William Blair. Please go ahead.
Hey, thanks for taking my questions. And first, congrats to you, Rick, on a great run, and really look forward to working with you, Ed. So maybe starting here on just the guide for the fourth quarter, just wanted to confirm that you're assuming effectively a 2-month slowdown for APEI US registrations here, and then kind of more or less back to normal trajectory in December and into 2026. Are we kind of thinking about that the right way?
So I would say definitely a slowdown in October, where I think we previously announced 1,700 registrations of TA flowed through, which is a substantial decline. And then about, at 30%, we were able to recoup for the November compared to the prior year, about 5,000 registrations. The low end of our guidance does contemplate some shortfall in December as we ramp up, not knowing the full, timing for the CR. But we'll see how that flows. If we can, get the CR in place, and we continue to see the flow through from the OBBBA, then obviously that would be towards the higher end of our guide.
Got it. That's helpful. And then on the cost saving side, I guess, can you talk some about where you've been able to cut near-term spending? How much of that could be temporary reductions versus cost cutting that could be more permanent and be something that help support profit and margin trends heading into 2026? Any detail there?
Not a lot, but I mean, we previously said where we thought we had opportunities, and certainly we've dialed back our variable costs that we think that we can manage through. We have taken the opportunity to, streamline some operations at APUS, so that is an important piece to this. But the most
which
part,
will be permanent,
which will be permanent.
That's a permanent reduction in force. Yeah.
But we've also made sure that we don't affect the revenue side of the equation. So we wanted to take the cost measures that we could, that we thought were discrete and would not harm the business going forward. Things like not over-investing in military marketing is a good example where, we could dial that back until we had some certainty of reopening. But some will blow through to next year, but not a huge amount.
Got it. Very helpful. And then just one more, if I could sneak it in, just on the nursing side. I guess, can you just talk about how general demand to pursue nursing pathways has changed? It seems like you've been putting up very strong growth here at both Hondros and Rasmussen, both 3Q and into 4Q. And generally, I think it's becoming even more attractive to learners to pursue nursing, given shortage, increasing pay, limited AI disruption risk, at least relative to other industries. So is that starting to play out here? Are you seeing any notable uptick in applications, and just generally, what are you seeing in terms of the top of funnel demand trends on the nursing side?
Yeah, I'll start by saying we're seeing acceleration. Obviously, we reported that we have a 13% enrollment growth on the campus side of Rasmussen in the fourth quarter, which we're very pleased to see. We, reiterate that the nurses that we primarily educate are first licensure, meaning that those folks are becoming nurses for the first time, as opposed to post-licensure, where they already have a license and are trying to advance their career. I think that there is a challenge across some sectors of the market around investing in that post-licensure degree program, because the pay increase maybe isn't meaningful enough to invest in that post-licensure career in the short term. We're seeing substantial pay in our markets right now. An LPN can make about $66,000 a year, and an ADN, so a 2-year degree RN, can make $88,000. And so those are very meaningful comp packages for a 40-year career for a single educational degree and license. And so it is attractive from an ROI perspective, especially with the price point of our programs. And there are plenty of open positions for people to obtain jobs. So we also believe that having insourced our marketing in the last 18 months, we've really started to tighten those dials and identify how to reach those students in the local markets effectively. And that is also driving the, quarter over quarter, year over year performance improvement in our campus-based nursing program. So we're very pleased with how that's performing.
Great to hear. Nice work in the quarter.
Thank you so much, Stephen.
The next question comes from the line of Jasper Bibb with Truist Securities. Please go ahead.
Hey, good afternoon, everyone. Just on the filling the back row strategy, I'm not sure if maybe utilization is the perfect measure here, but is there any way for you to frame for us how much more room you have to drive enrollment into those existing programs and campuses at Rasmussen?
Great question, Jasper. We're going to talk about this next week in our upcoming Investor Day, where we're going to give you a multi-year view of the different capacity opportunities. We've clustered our campuses into 3 segments because, as we've talked in previous calls, our smaller campuses have arguably less total seats available. Our, basically single market campus opportunity is the area where we believe there's the biggest opportunity in terms of filling those campuses. And then our multi-campus clusters in a single market also have significant demand. So we really look forward to sharing that with you on November 20th.
Okay. Well, looking forward to hear more detail on that later this month. And then just last one for me, are you expecting the decline in the registrations at APES during the fourth quarter should give you a bit more cushion against 90-10 in the 25 calculation? I imagine from a mix perspective that might be helpful.
What we have seen is, interestingly, a shift primarily of our graduate military students paying their shortfall with cash. So instead of sitting out on the sidelines and not using TA, waiting for TA to come back. We actually see grad military paying cash. And so, every cash payer, you can get one of those for every 9, or 8.9 TA or FSA users. So that certainly has had, in a somewhat unusual way, had a positive impact on our 90-10 calculation, yes.
Got it. Thanks for taking the question.
Great question. Thanks.
Your next question comes from the line of Eric Martinuzzi with Lake Street. Please go ahead.
Yeah, just curious to know for the non-military, so the military affiliate and veteran, if those the registration trends are on track for you for those student segments.
Yeah, actually Q3 and year to date, this is Gary, we've seen very nice acceleration in the growth of both the extended family segments as well as the veteran segments. So I would say a lot of the 8% growth that we saw in Q3 was attributable to those two segments where in the military, I'll call it steady Eddie, 3-4% growth. So I think we're very pleased with the performance year to date and especially in Q3 of those two adjacencies.
Gotcha. And then it was great to see the Rasmussen on-ground 13% enrollment growth. Is that something that you feel is sustainable, that there's a tailwind here macro-wise?
I'll start by saying we're firing on all cylinders now in terms of enrolling in our campuses. Certainly as we start lapping ourselves, the comps are going to get, trickier, but we believe there's a tremendous amount of opportunity to fill the back row of our RAS campuses, and so we're focusing a disproportionate amount of our marketing spend where it makes sense to make sure that we're continuing to deliver on that enrollment momentum. So yes.
Okay, that's it for me. We'll keep our fingers crossed for conference.
Great.
Thanks, Eric.
Thank you, Eric. See you next week. Thank you.
Your next question comes from the line of Griffin Boss with B. Riley. Please go ahead.
Hi, good evening. Thanks for taking my questions, and I appreciate all the color you've given so far. Just one for me. I'm curious if you could dig in to kind of where we should expect to see some of these cost-saving initiatives implemented in the fourth quarter. Obviously, it looks like you pushed out some CapEx spend maybe to 2026 or beyond. That guidance came down a little bit. But in terms of the OpEx, just curious, are we going to see kind of a little bit more initiative on like the selling and promotional, marketing expenses, or where should we see, kind of a relative uptick as a percentage of revenue in some of these areas that maybe you were not able to implement cost-saving initiatives?
Yeah, I think we talked a little bit about this previously, but definitely S&P, there will be a little bit of savings there. We want to make sure, obviously the timing of when everything comes back online will dictate that. We are looking at, temporary and sometimes more permanent, staff reductions in non-student facing functions. And then I would say we talked also about our variable comp that is tied to performance, and that is another lever. It's also important to note that, given our variable cost model at APES, which is on a per registration basis, that while we may lose X number of registrations, the variable cost for that will also come down. So there are three big buckets there, aside from the little things that you always look at, like external consulting and travel, entertainment, and like. So those are the major areas that are contributing to the cost savings.
Got it. Okay, thanks for the color. Well, great work navigating what has been a tough environment, and look forward to hearing more details next week at the Investor Day.
Super. See you there, Griffin. Thank you.
Your next question comes from the line of Raj Sharma with Texas Capital. Please go ahead.
Hi, good afternoon. So thank you for taking my questions. Again, solid performance and resilience in the face of tough testing conditions. I had a question on it was great that the $100 million tuition assistance fund you're able to use that. Any delays in payments from this to you?
Raj, that's a good question. We are going to bill, according to our stated policies. I think the question is whether or not there are people working on the other end to actually push the button. But I'll turn it over to Rick, who's on our call here today. Rick, do you want to say anything about that?
Yes. Thank you. Raj, it is impacted by staffing at the various branches. They're just not there to process the invoices. But the good news is was highlighted on the call. I mean, we've got a pretty substantial cash reserve to weather the very short-term shutdown. What feels long, but is actually relatively short, given the month or two of processing that would be otherwise processed.
Got it. Thank you, Rick. And then I wanted to understand that now that the government assuming when the government shutdown is over, it's business as usual in the sense that there likely isn't any medium-term or permanent damage from this on the enrollment. And then also any of these registrations that you weren't able to get in October and November, are these sort of is this lost revenue, or is there a scenario where service personnel might want to double their course load to make up?
Well, I would say that we are forecasting, Raj, that what would have otherwise occurred in October and November has just simply shifted on the calendar, right? We know that the reason why we purpose-built our education model to allow students to take one course at a time is because they don't often have time to do more than one at a time. And, our flexibility allows them to pause and then restart. So we may see some people who are, gunning for a promotion or something, who want to keep moving, like we saw some of these grad military students who are paying cash to keep going. But I think by and large, we're forecasting that we're basically going to just see those shift to when everything restarts in earnest.
Got it. Thank you. And then on Rasmussen's side, the programs that are particularly showing really good momentum, the on-ground healthcare, up 13%. Any specific programs there that are doing really well, and you expect that enrollment environment to sort of continue?
Yeah, I would say our allied health programs, our rad tech and our surge tech programs are doing good, although they're pretty capped right now that we're working on as part of our plans to expand that. But it's really nursing. It's been across the board, predominantly in our ADN program and BSN. And it's also important to note that our growth of 13% includes the closure of 2 campuses in Wisconsin. Not that they were huge contributors to enrollment, but it gives you a sense of how our nursing programs are growing. So we're really pleased with both our BSN and ADN programs, and to a little bit smaller extent at Rasmussen, the LPN program. But it's across the board nursing.
Got it. Thank you. That's it for me, and I look forward to seeing you all at the Analyst Day.
Great. See you next week, Raj. Thank you.
Yeah, absolutely. Thank you. Take care.
The next question comes from the line of Alex Ferris with Barrington Research. Please go ahead.
Hi, guys. Thanks for taking my call, and quick welcome to Ed. Look forward to working with you, and a so long to Rick. I've enjoyed working with you.
Thank you. Looking forward to it.
Great. And now I know how to pronounce your last name, now that you have the Cody.
There you go.
Perfect.
Just a few follow-ups. First question, on the fourth quarter guidance, on just overall revenue and then APES registrations, what are the assumptions at the low end and the high end? And a related question, and just to be clear, in October, even though you had to stop out some students, you still kept 1,700 students under TA, and then students that had been previously approved. And then in November, you said you're able to bring in 5,000 under the $100 million OBBB?
Yeah. So I'll answer that, Gary. So if you think about November, about 30% of what was the prior year's registrations made it through. So on prior year TA registrations. So we're modeling on the low end that's probably the same, knowing that we've seen some improvement. That was, OBBA, literally, those changes got enacted the very end of the enrollment cycle. Some of the branches did keep open for continued enrollment for 7 days. So we expect to do better than that. So at the high end, we're obviously assuming that we're able to improve upon that number. So we're trying to bracket it on what we saw in November on the low end, and on the high end, what we would expect to see on normal pacing once either the CR goes through or if the OBBA funding continues to flow.
And then just remind me, what was the October TA registrations as a percent of the prior year? It was like 40% lower, wasn't it? Or
a lot. No, it was 1,700 registrations on what normally would have been. I'm going to say this is exactly right, but 17,000 registrations. So it was probably 10%. So it was a very small number. It made through.
All right. And then it improved. You got 30% on a year-over-year basis. You got 30% of what you had in the previous year, as opposed to just 10% in the previous year. And then in December, you're saying the low end would assume that same 30% of the year-ago month. And the high end would be something higher than that.
That's correct.
Okay, good. Thank you. Question 2. Well, that was question 1 and 2, actually. Question 3. The graduate school USA loss of $3.9 million. Was that a lot less than you had forecast? I thought on the last call you said to assume a $7 to $8.5 million loss on sale.
Yeah, Rick, do you want to answer that one?
Yes, and the answer is yes. Alex, in the prior call, we estimated 6.5 to 8. We came in at 3.9. The difference was the resolution of this is an accounting matter, the accumulated deficit that existed on the books of graduate school, a separate company. To eliminate the deficit, we had to record a credit, which was an offset to the otherwise, higher number. So that number came down.
Thank you. And then the last question, again, just point of clarification. Post-licensure, pre-licensure. Hondros is all pre-licensure or
yeah. All pre.
And then Rasmussen has some post-licensure?
Yes. A small percentage.
Yeah.
Yeah.
Okay.
But but the post-licensure is contained within what is currently categorized as our online business. Right, because that's all delivered without a need for a campus, yeah.
Great. Well, thank you very much. I'll take the rest of my questions offline.
Okay, thanks, Alex.
Your next question comes from the line of Luke Horton with Northland Capital Markets. Please go ahead.
Yeah, hey guys. Congrats on the nice quarter. I know we've kind of answered most of the questions here, but just wanted to kind of touch back on the strong enrollment trends at Rasmussen, specifically on ground. Are you seeing a change in student demographic at all with the students that you're gaining here? And is this simply just a function of more efficient marketing and macro demand, or is there just anything else you could provide there would be great.
Yeah, great question. Nice to hear from you, Luke. We are really trying to expand our marketing reach to not just enroll ADN or the 2-year degree RN students, but also the BSN, the 3.5-year degree RN students. And so we are seeing momentum in both, but we are seeing an acceleration in our BSN students, which we're really pleased about. Has a longer tail of revenue, often stronger NCLEX results. So we love that we are expanding our pool of BSN students at Rasmussen.
Okay, got it. And then just one more, I guess, on the campus-based enrollment. I mean, are you seeing anything from a geographical standpoint? I know you're mainly Midwest at Rasmussen, but from in Florida to Kansas, like, are you seeing any specific campuses outperforming on new starts or new student starts at all? Or is it pretty much broad-based?
I was going to say, it's a good question, but I would say it's broad. I think we're especially pleased with I'll call it Minnesota, where, as you recall, we ceased enrolling in our ADM program, and to what Angie just said, the BSN has been a nice lift there. But no, it's been across the board. I mean, it's been nice to see in Kansas and Illinois, at Minnesota, as well as in Florida.
Okay, great. Awesome. Well, thank you guys for taking the questions, and congrats again on the quarter.
Thank you, Luke.
There are no more questions at this time. I would now like to turn the call back over to Angela Selden for closing remarks. Please go ahead.
Thank you, Eric. I'd like to thank each of you for joining our earnings conference call today. We look forward to continuing to update you on our ongoing progress and growth as we continue our rapid pace of enrollment growth, revenue growth, and margin expansion. We also look forward to welcoming many of you to New York City next week for our 2025 APEI Investor Day conference. If we were unable to answer any of your questions, please reach out to our IR firm, MC Group, whose contact information is on the last page of the PowerPoint, and they will be more than happy to assist getting us all connected together. So back to you, operator.
Ladies and gentlemen, this concludes today's call. Thank you all for joining, and you may now disconnect.